What's going on, everyone? Welcome on into the TC Trading channel. Today we are covering 3 reasons to trade futures over options. Now, I'm not here to sway you and to tell you that you should never trade options again, but in this video we're going to cover 3 perks to trading futures over options. But at the same time, I do want to also point out a negative, so kind of a bonus almost, into why someone might not like trading futures over options through some examples that I have seen myself and other traders. We're gonna keep this video short, sweet, to the point. We're gonna cover those 3 points in that bonus, and then we're gonna get you out of here with that new knowledge. But first, a few words from the sponsor of today's video, Jigsaw Trading. Jigsaw Trading offers traders an edge in the markets through powerful and intuitive trading software. With advanced tools for order flow analysis, visualization, execution, and advanced analytics and trade journaling, Jigsaw Trading gives traders a real-time view of market activity and helps them make better informed trading decisions. Whether you're a beginner or an experienced trader, Jigsaw Trading has something to offer, from their starter package to their professional package. Plus, their team of expert traders is always available to provide guidance and support. Take your trading to the next level with Jigsaw Trading. 14-day money-back guarantee. Try it today. Thanks for Jigsaw for sponsoring today's video. Okay, so number 1, that's going to be time decay. Now, what do we mean by time decay? Well, if you're trading options, you understand, or you should understand. If you haven't, please go back and watch a video on this channel that covers how to trade options. There is a factor of time decay. If you are holding an option position and nothing is happening and the stock is just trading sideways, the option's actually going to be losing value over time. And there's actually a way to calculate that, and that's through theta. We've got a video on the channel covering theta if you want to check it out. It's something that you need to understand, and if you do understand it, well, guess what? Futures, you don't have to worry about time decay. When you buy at a price with a futures contract and price action is sideways for the rest of that day or for the next 5 minutes, 20 minutes, hour, 2 hours, you're going to be at a 0 P&L. Like you're not going to lose value on that futures contract. Now, there's still expiration dates to pay attention to and so forth when it comes to futures. Depending upon what markets you're trading, things could change and there could be different time horizons of trades. But if, let's say, you are a day trader or a short-term swing trader, it's a massive benefit because you don't have to worry and you're still going to have plenty of leverage. Number 2 is pricing and liquidity. It kind of plays off, but pricing plays off of this time decay. Right? There's so many other factors that are involved in the pricing of an option contract. There's things like implied volatility, there's theta decay, there's intrinsic versus extrinsic value. There's all these kind of confusing things that people should know before you get into options trading. If you get into options trading and you're going in blind and you have no idea how it works, yeah, if you pick the correct direction, you can make money, but you're gonna have situations that come up over time where you're like, the stock went my direction or, went decently in my direction, but I still lost. How is that possible? Well, when it comes to futures, you don't have to worry about that. You don't have to worry about things going your direction where you're making that bet for a, price to go up or down and losing. If it goes up, you're gonna make money. If it goes down, you're going to make money if you bet with the set direction in mind, right? If you're betting on the short side and it goes down, you'll make money. If you're betting on the long side and it goes up, you'll make money. It's pretty simple, right? And it kind of makes sense, right? It makes a lot more sense than options when it comes to pricing. Now, the liquidity side is the other factor. What's that? I want to play off of that because it kind of plays into the same thing, where option contract could have these very large spreads where if there's not a lot of volume or liquidity, then you could be dealing with a contract that has a 5 or even 10%, sometimes I've been seeing even larger spreads between the bid and the ask. And do you want to be buying at the ask and then trying to get out and have to sell at the bid and immediately lose 10%? I've been there, I've done that, and it's not a lot of fun, especially when you increase the size, right? So it forces you to keep your sizing small when you've got low liquidity and low volume on certain option contracts. So if you want to go trade some obscure stocks, you might not be able to when it comes to playing options on them as easily as when it comes to futures. You could go trade some obscure futures. If you want to trade corn, if you want to trade wheat, if you want to trade the S&P, you can do it all. And you don't have to worry about the liquidity factor for the most part. Now, number 3 is, I think, the biggest piece to this puzzle and one of the best perks of futures over options. But before we get there, I do want to talk about a potential downside. Like, what could be a reason that you don't want to trade futures versus options? Well, when it comes to futures and options, options could offer more sympathy and relative strength or weakness trading. What do I mean by that? Well, if you're looking at a sector, let's say it's big cap tech, large cap tech stocks, well, what you might find is that you can go and look at Apple, and you can look at Tesla, and you can look at Microsoft, you can look at Nvidia, you can look at all these stocks, pair them up together, and say to yourself, oh, we've got relative strength in Apple today, we've got relative weakness in this stock today, and you can use that to your advantage and trade based off of that. So if the markets are trending higher, the S&P is up today, or the NASDAQ's up today, you're looking at tech stocks, and Apple's the strongest of the group, well, would you prefer to place your bets with Apple, or would you prefer to place your bets with the weakest name of the group that might be Microsoft that day? Well, chances are, at least in my experience, I found that Apple tends to work out more when we've seen that relative strength versus other stocks that are similar. So you've got more of that could offer a trading edge where you might have a little bit less of that, or it's a little bit tougher to find something like that when it comes to trading futures. And so I know a lot of people, even myself, when I do trade options, that is at the forefront. That relative strength, that sympathy is at the forefront of why I would be taking this trade. I am not randomly taking the trade because the chart looks good or because I think it's going to go up. I'm saying, okay, the charts are lining up in this manner. Here is my setup. This stock is the strongest or the weakest, and I'm playing upside or downside accordingly. Number 3, I think hands down, this is my favorite part, especially if you're profitable as time goes on. It's called the 60-40 rule. Now, what does that mean? Well, the 60-40 rule means that 60% of net gains on futures trading gets treated like long-term capital gains. The other 40% is treated as short-term capital gains and taxed like ordinary income. So think about this. If you are someone who progresses and gets substantially profitable, or is someone who has a job and makes good money, and you use your futures trading and whatnot on the side, let's say you swing trade, and you've gotten pretty good, and you do this on the side, and it's not your main income, and you want to minimize your tax burden. Well, if you trade options and you're day trading and short-term swing trading, and you're not holding for over a year to get that long-term capital gains benefit, where you'll be taxed a little bit less potentially, or most of the time you will be taxed less. Well, if you trade futures and you're profitable, 60% of your gains, say you make $100,000, okay? $60,000 gets taxed at long-term capital gains, even though those gains were short-term capital gains off of day-to-day, week-to-week futures trades, which is pretty cool. And the $40,000 gets taxed as short-term capital gains and taxed like ordinary income. So let's say you're making $100,000 from your job, you make an additional $100,000 from trading. Well, $60K gets taxed as long-term capital gains. That $40K gets kind of taxed just as if you were making more money, and so it gets taxed at a higher tax bracket level, and so you'll pay more tax on that. But you would have to do that anyway if you were a consistently profitable options trader and made $100,000 in options trading profits. Guess what? That's all getting taxed at the short-term capital gains, which the more money you make, the more tax you're gonna pay. There you guys have it. Those are the 3 reasons to trade futures over options. Hope this video helped you guys out. Make sure to check out the link down below for Jigsaw Trading if you guys are interested, and we'll see you guys in the next video.